All right, we are up and running. It is recording, so it'll show us all here. All right, cool. So we're looking at that camera right now. How are you guys doing? This is Intellectually, the show where we teach you to how to better hold us professionals accountable. We are here with Matt Dickens. You are a mortgage lender. So you profession in the first-time home buyers right now, correct?
Yes, correct.
Okay.
I do.
And we're kind of in the series right now where we're talking to investors, people that are, looking at investments. We're trying to hit the basics, and this is the lending portion of it. You have a particular interest in investing mortgage-wise, correct?
I do, yeah. I bought my first duplex and house hacked that at 23, so.
Excellent, excellent. And if you don't mind, just kind of tell us about your career. Introduce yourself. I'm Robert.
I'm Chad.
Yep, so you guys know us predominantly. We want to know a little bit more about you, though, Matt, so give us the showdown.
Okay, yeah, so, long story short, not going to give you the whole life story, but my introduction to mortgages was through house hacking. So I went to Mizzou, graduated, got in the commercial real estate space. I was pushing paper, to be honest with you. It was a very corporate job, and I had more in the tank, and I picked up a book on house hacking, pitched it to my wife originally. Yep. She thought I was an idiot. And it was like, absolutely, we're not doing that. We're never doing that. What are you talking about? A couple months later, she's like, let's house hack. So we bought our first duplex in October of 2020. My lender at the time was like, I feel like you would like what I do. Why don't you just shadow me for a day? And like I said, I wasn't loving my corporate job. So I was like, absolutely. And went over to his house. This was in the middle of COVID. So rates were at 2.5.
Lovely.
And this guy was just... closing a lot of loans, doing it well, and I saw what the mortgage world looked like.
Oh, yeah.
And quit my job the next day and joined him. So
where were you working at the time?
Cushman & Wakefield.
Okay.
Yeah.
What were you doing there?
I was a portfolio lease administrator.
Okay, so you already had the skill.
Yeah, I was reading leases.
You were in the
industry.
for
I just
sure.
mean because it takes a lot of analytical skill to do what you're doing, you know, to just look at everything and make sense of it, so.
Yeah.
Maybe I'm wrong.
No. I'm a lot smarter than I look. I just look like no. But yeah, it's a good job. I love mortgage. I love helping people. So yeah, I focus on first-time home buyers and then investors as well, and a lot of first-time investors.
Oh,
so.
yeah. Excellent.
Cool.
So keep going.
And say you've talked a lot about this house hacking, right?
Yeah.
This idea of house hacking. Now, last podcast we went a little bit in depth on how that process works, but I want to kind of hear it from your perspective too. You know, talk about the house hacking. Exactly what is it, especially in your eyes? And this is going to be a majority of our conversation.
Yeah.
So why don't you get us started there?
Yeah. So house hacking, for a person that doesn't know who that is or what that is, house hacking is a investment strategy that I think is the best investment strategy to start your investment portfolio with. It's buying an investment home, but as a primary residence, and then you live in the house. So your loan is a primary residence loan. But then while you live there, you rent out either a bedroom or other units. So from my experience, we bought a duplex for 5% down, lived in one side, rented out the other, and the rent that we earned from the other unit paid for 80% of our mortgage while we lived there.
Brilliant.
So then when we left and moved out, we filled the unit that we lived in. That property became a fully functioning investment property that we only bought with 5% down. Yeah. And now it's cash flowing. So
and it's cash flowing, building towards a future. You got these people contributing to 401ks. You're basically making your own solid retirement plan just by having this mortgage cover most of it, and your renters pay for that mortgage, and in the long run,
that's exactly
you're going to be able to cash out or keep that as consistent income.
Yeah.
I like the idea of house hacking. Always recommend it to first-time home buyers, especially when they are young and agile, right? Because it's not passive income. No. It's still going to take a lot of time, a lot of interest. But the cool thing about it is you're living in the homestead, so it's a lot easier here and there. I do warn a lot of buyers, though, when it comes to house hacking, you got to figure out how to be as hands-off as possible because you still want, when it comes to money, you don't want to get personally involved with your renters. Can be painful. Did you experience anything like that?
Did I experience something like that? Yeah. So quick anecdote here. I'm 23. When I was house hacking, right?
Yeah.
So I'm fresh out of college, and the tenants that we were interviewing, we finally landed on this young couple that was our age.
Oh yeah.
And so I'm telling my wife, I was like, we're going to be best friends. We're going to grill outside. It's going to be great. Like, we'll have game nights.
That give
this
me
is going to
money.
be amazing. Yeah, well, like, that was a terrible idea.
No.
Because I can show screenshots of, like, they wanted me to come over and kill a bug. They wanted like to share groceries. I'm like, no.
Mm-hmm.
Back it up, Terry. I regret everything.
Don't say names. Back it up.
No, I'm referring to the viral video.
I was like, did he accidentally just give that? Terry's over there watching this podcast. Like,
yeah, like, damn it, man. So yes, like for sure, caution. Even if you are a friendly person, like try to keep it a professional relationship in which you can do so with your lease.
Yeah, there's a way to be hands off, and it's more respectable in my eyes too. When you treat them like a business, and you keep the personal out of it. I can also see some landlords, they make the mistake where, they personally get involved and they start asking favors of the tenant, you know what I mean? Or sacrificing them for their own means. So.
Yeah, well, ultimately you want them to respect your property.
Mm-hmm.
And this is a similar relationship to like a disciplined father with their children. Mm-hmm. Like if you have parents that are always your friend, you live in a world that you don't have a lot of rules, and we all know what that lifestyle
Sooner or
yields.
later, Sooner or later, somebody gets screwed.
Yeah.
I don't want to live in an environment.
Yeah,
like
keep
that.
it professional for sure.
Yeah.
How long did you live there?
I lived there for 12 months.
12 months.
So
exactly.
So you
12
nailed
months.
it to the point.
Yeah.
So why'd you, for those who might not know, why'd you live there for 12 months?
So when you buy a really any one to four family property, and you intend to live there as a primary residence, the loan that you get is a primary residence loan, and it's understood by the bank that you're going to live there for 12 months.
Mm-hmm. It's written into the deed of trust, right?
Correct.
So a lot of people will say, like, if you get an FHA loan for any property, you're going to have to live there at least for the first 12 months. Yeah. Makes perfect sense. They would think, oh, well, I'm getting a conventional loan on this property, so I can move out whenever I want. No, in the deed of trust, even if you're still doing conventional, you got to be there for that 12 months because it's written into the deed of trust.
For sure.
No, completely agree with you on that idea. Thank you for clarifying.
Yes.
Keep going. Sorry, we got a list of questions.
Bang
the way this is going, it's going to...
Well, I guess while we're talking about house hacking investments, what is the process of purchasing a house hacking or any investment property for that sake? What does the property on the mortgage side or the process look like on the mortgage side?
Yeah. Do we want to stay within the house hacking lane?
No, I mean, it's up to you. I think our viewers our listeners can really kind of make it work themselves. So just keep in mind, this series we already claimed, we're talking residential. We're talking... We're talking residential, which is 1 through 4 family properties. So you can house hack any one of those. Technically, you can house hack a commercial, I guess, if you want to. But that's a little bit more. So we're sticking residential. Just remember everything Matthew is talking about. There are some caveats in which what he says might not be speaking to house hacking, but it can all be kind of utilized with that same mindset. Would you agree?
For sure. Yeah, and everyone's, we'll preface that every situation is so different. I know that's so annoying, like as I'm about to provide facts. So when you go to a bank and you want an investment property, the bank, a lot of people, for a house hack loan, you're going to be living in the property. So it's not an investment loan. And so it'll probably be helpful to explain the difference between an investment property loan and a primary residence loan. Those are the two. That's the distinction. A primary residence loan, you're going to see a lower rate and less down payment required. So right now you can put 5% down on a multifamily property, so a 2, 3, or 4 unit, if your income qualifies. On FHA, you can buy a 2, 3, 4 unit and do 3.5% down. So if you're going to be living in the property, that's 2, 3, or 4 units, you have conventional and FHA options. And you either put 3.5% down or 5%. On the flip side, if you are not living there and you're buying an investment property, just solo dolo, you have your own house or you rent, you just want to buy an investment property, the financing looks a lot more grim. Interest rates are higher and the down payment requirement is much higher as well.
But you don't have to have income. There's 4 key acronyms you're about to bring up when it comes to that.
Yeah, well, it just depends on the loan that we write. So let's kind of look at the investment only loan.
Okay.
There's two ways we can look at it. You have a conventional option, and then you have a DSCR option.
Elaborate.
So the conventional option, when you want to buy a property and as an investment vehicle, the bank is going to underwrite the loan based on your personal finances.
Yep.
So Robert, what do you do for a W-2? And what is your monthly debt? What is your personal credit? They're going to look at your ability to pay the mortgage. That's the conventional lens.
Yep.
On the other end is the DSCR lens, which stands for debt service coverage ratio. We don't care about your personal income. We
Just care about your money.
Yeah, we use the property's rental income. So the DSCR, debt service coverage ratio, is the ratio of your monthly rent versus the monthly house payment.
Yep.
That's how that loan is underwritten. And so there's a lot of ways that we can go from here, but it's important to make the distinction of if you're going to be house hacking, that means you're going to be living in the property. That is why it's such an attractive investment strategy, because you utilize the best loan that's available, which is the primary residence loan. Better rates, better fees.
So I got 3 questions that I believe somebody would want to ask after you explain that. One, how the heck do you decide how much the property can make? Right? Because you got this whole idea, you probably would talk to, if you're looking at investment properties and you try to talk to the homeowner, he'll be like, you can get $1 million for this thing in income. Obviously that's not the rate. You also have the agent that you might hire to advise you, and the agent would be like, yeah, I could see a solid like $900, $1,100 coming out of each of the units. Do either of those people have a say?
Yeah, you definitely want, that's the power of a good team, is having a realtor that specializes in this, because they can help people with those rents. But the lender, so we care about the way that we calculate the income. If the property is going to make income, mind you, we only care about that if we're doing a DSCR loan.
Yep.
We look at the market rent determined by the appraiser. And then we look at any available leases.
Got you. So you hire a third-party appraiser to go out there. He analyzes the situation, looks at the quality of the property, compares it, and he comes up with, no matter how much the current residents are paying, he goes out there and on his own bias, not biased to any of you guys, tells you how much this property could bring. Correct. Yeah. So that's the idea. Don't get all excited because you're going to have this third party come in. We have a lot of investors. Sorry, I should probably.
I heard that's changing soon a little bit. How they
look at the market rent?
Well, as the appraisal process going from is it uniform appraisal data set? You familiar with that?
I haven't done much research on that. If it's a new rollout, do tell.
It's new. You got it right here. You got it pulled up. So if you want to read what you got,
I don't know.
Bring it, Chad. Let's go.
Too much about this topic, but the platform, the data set that appraisers use, national data set, UAD or Uniform Appraisal Data Set, what is it, 2.4 or something like that was the old version. They're introducing 3.6 out in November, which is supposed to give appraisers a lot more data profiles or characteristics to make it, I would argue or guess, the appraisal process more consistent for lenders like yourself and appraisers of all that.
An appraiser has his specific sheet of paper and algorithms that he has to fill out. Basically they're just going to add.
Yeah, they do the income approach, the cost approach. I think they need a what the heck is this market approach.
I think that's the idea of what they're trying to do. They're trying to not broaden. They're trying to, I guess, be more specific with some of the ratings that they're giving these properties.
I think you guys would agree why they're trying to do that, right? Because, I mean, when we try to go in and analyze the value of a property via the rent income that can come from that, I would say 40% of it is gut, because you're looking at it, and I would say 30 to 40% of the landlords that are renting these units aren't reporting technically to the sources we can get it from, right? You got different MLS sources. You can go to the market and see what people are charging, how long it's sitting on the market. There's other sites. But in the long run, the rental industry on a 1 through 4 bedroom property, the data really isn't that confident. You know what I mean?
It's a lot of private data, right? And so Rentometer is a good source that I used to use, and a realtor, honestly. A Rentometer and a realtor to help you underwrite loans that you're looking at, investment properties. I think that's a great starting point for sure.
Beautiful. Now, thanks for clarifying how you guys, because I think it's very important that they understand that you're not going to get any of your bias, no matter how proud you are of this property or what you think you can get from it. That lender, unfortunately, doesn't care, and it's good that they don't care.
Yeah.
Right? They need the cold hard facts, non-biased opinions of how much.
I just had a client that we just got off the phone a couple hours ago, and she's like, "Is there anything that you can do to get me?" I'm like, "Sweetheart, I would give you $1 million loan with a driver's license, but there are rules that I have to follow." She's like, "I understand."
You're like,
so
"It's
there
not
is
my
literally
money."
there's no gray area
Yeah,
when we're talking about these limits of loan. For sure, we're hands are tied. Okay.
Yeah. No, it makes perfect sense. Before we move on to the next question, when it comes to DSCRs, another thing I would argue is a lot of first-time home investors, 1 through 4 family, they're not really aware of a DSCR. So I would just like you to elaborate on some key points that you, maybe when you started out when you were 23, you might have wished you knew about a DSCR loan. Do you have any pointers?
Yeah, for sure. So when I was 23, DSCR wasn't really too popular of an avenue. And it's because the DSCR product is solving an income issue.
Yep.
A lot of investors, they don't show a lot of income on paper.
Of course.
So when they go to the bank and the bank tries to get them a conventional loan, they run into DTI trouble, debt to income trouble. Basically, they have too much debt.
Of course.
And not enough income. So the DSCR solves that problem. When I'm 23, and a lot of newer investors, the house hacking method via conventional or FHA financing is the way that you want to go.
Yeah.
Because it's a low down payment
course.
And better interest rate option.
Because the DSCR loan has more risk.
Correct. Yeah, and more down payment required.
Yeah, so more risk, more down payment.
Yeah,
You need more money up front.
And yeah.
I don't blame them.
Yeah, so you're not going to see a lot of DSCR products that go under 85% LTV. So less than 15% down.
Mm-hmm. No, that makes sense.
I don't know. I think that's you mentioned it, but what kind of rate differences are we talking about when it comes to investment primary DSCR loans?
Okay, so
that's tough to say. Don't worry.
Is.
This is all with a grain of salt.
No, that's fine. Yeah. There's ranges and definitely comparisons.
But don't go come find Matt.
Yeah,
like, hey,
no, he said 6.25 on the podcast. No. So DSCR is actually really competitive as compared to conventional.
Yeah.
Right now. But it really just depends. Like there's a lot less variance. So if you have a lower credit score, DSCR rate is probably going to be much higher than conventional. So
makes sense.
But primary residence, much better. So primary residence loan, house hack with a conventional or FHA versus DSCR, you might see 0.5%.
Yeah.
On aggregate, on average there, I would assume.
So I guess one final question that might be, so of the 3 that I was going to ask you, so thank you for clearing up the idea of appraisers, kind of evaluating DSCR loan ideas. The final one that I think is important is when it comes to, I lost it a little bit. We might have to come back to it because I want to organize the question.
Yeah, you're fine.
It's more of a universal, so keep going to the next one. I'll think about this question, then I'll ask it.
Okay. All right. So
like,
you threw me off. All right.
Yeah, I'm sorry.
This specific one is how can one avoid a property from becoming a debt in a lender's eyes, your eyes, when applying for a loan on a future property?
Yeah. This is something I speak to a lot because I have a client and a couple that they've done a great job managing their debt to income ratio, managing the amount of loans that are on their personal credit because they want to continue to buy property. And so they've acquired these properties strategically. So the biggest way that we minimize the amount of debt is to limit the amount of borrowers that are on the loan. If you guys wanted to buy a property together, my goal would be to get the loan approved with just one of you on the loan.
Yep.
Because in the future, when you want to buy more properties,
put him on the loan instead.
You want to put Chad on the loan.
Notice
so we want to minimize the borrowers. Is the
utilize
biggest,
all those benefits
that
come with first-time home buying.
Correct.
Yeah, but so as long as, just to clarify that, as long as one person on the loan is a first-time home buyer, you can get the benefits. So it's more along the lines of like, he would like to have all the burden on you on your name. And so he could put new burden on me if we wanted in the future. Makes sense. Yeah.
For sure.
Keep going. Sorry to cut you off.
I think that was wrapping up that.
Okay.
Sometimes, new investors come across our desk and they have a variety of properties on their credit. That's because those loans were written in their personal name.
Yeah.
And so if someone's trying to limit that, then you need to get commercial financing, or you need to do a DSCR loan. Both of those loans are going to allow you to close in an LLC.
Yeah.
Which protects your personal credit.
And limited liability.
And it does not show up on your personal credit. When a bank does your credit report,
of course,
if you have 100 properties in an LLC, I'm only going to see 0.
Yep.
Because 0 are in your personal name. But like if we have DTI issues with clients, it's hard to solve that problem. You have to refinance out of all of those loans and put them into LLCs. A common myth is that you can do like a quit claim deed.
Yeah.
That only handles the title.
Well, it is hilarious. Yeah. And there was a very bad advisor that was telling somebody who was like, my wife's going to be on this, and he wanted to do something about the loan and stuff like that. And all they said was, yeah, no problem. After you close down, just do a quit claim deed. And I was like, just remember, like a quit claim deed, I could write one up right now, and I could sell you this bedroom. I could sell you that TV. I could sell you this table. We'd do a quit claim deed right now on that if you wanted. It's just the trouble. If it ever gets challenged, that's where the quit claim deed starts to have issues. So what a quit claim deed is really it's just a quick claim of moving of property, right? And anybody can mess it up. And if an attorney gets involved, if somebody tries to challenge that deed or that, that claim, and there's errors in it, then absolutely. Yeah. So the way I always advise quit claim deeds is they might work. They might be sealed tight, right? But the reason these other forms of general warranty deeds, special warranty deeds, is there's just more hands in the cookie jar. More people do identify opportunities that might be held accountable down the road. Would that be a good way to put it?
No, I would, yeah. And it's honestly pretty rare. I would say less than 5% of investment loans that we do end up being quit claimed.
Oh, of course. Yeah. And it's usually when they quit claim it, it's something within just correcting a name or something, it's something that will hold up.
Yeah.
To your point, you were talking about moving burden of one property onto one person so you can then utilize the other person. Another thing we talk about is like Chad has a personal experience with this.
He's like, what the heck?
No,
man?
Personal experience with this. When you took on some clients, these poor clients, they purchased a property a couple years ago or a year ago with the objective of house hacking. And they weren't advised properly the valuation of the property, where it would go when it comes to the mortgage, where it would go to the market, how much it would make if you rented both units out. But it was a duplex, right? And
their mortgage was like 33 to 35, and it was duplex. They weren't bringing more than $3,000.
The mortgage was 33 to 35.
$100 a month.
Yeah, and the market rate was around 15.
This is in Dogtown.
Per unit.
The rent, so they're already starting under.
They're just they're maybe $300 to $400 above their mortgage. And one thing I always advise is rule of thumb, try to be at least 1.3, like 130% higher than your mortgage. More particularly on the more expensive properties, because those dollars really start to. If it's a younger or smaller property. Less in price, under 100,000 or 120,000, you can start to test those boundaries. But that rule of thumb where they say 125% to your mortgage, you need to have that income, or your mortgage needs to be 75% of your income. I would argue you get more expensive, it needs to be even higher, because those $100 start bleeding a little bit. So elaborate on that mentality, if you will, on what you guys look for. Were let's say somebody house hacked, and they bought a house where they were going to rent one side out and live in the. They were going to rent.
First, you're going to make fun of me. Now you're going to destroy my mic. Okay, partner.
No, I think it's this thing that needs to be tight. Hold on. Yeah. No, it's good. I was looking on the camera. You're probably just going to go. But the idea is we've seen so many people they now have this property. Let's say they're bringing in $3,500 evenly, and an appraiser can evaluate that. He'll go out there and be like, yeah, this property will bring in $3,500, but they have a mortgage that's $3,500. Let's say they want to buy a forever home. What does that look like to you when you open the books up?
Yeah, I mean, I kind of want to go a different direction with this question.
Do it.
And take off my lender hat and put on my I'm a landlord hat. I just spent, well, my wife just spent like $1,200 buying a new fridge. Okay, if I'm cash flowing $100, then all the cash flow that I just had for a year is gone, and so all of these numbers and calculations are nice, but it just depends on your goals as an investor. If you are someone that has a job right now and you don't like your job and you want to use real estate as an avenue out of your career, you need to start building passive income. And so each property that you earn or buy needs to cash flow more than $100 a month. My investment goals are not that. I enjoy my job. It's a great job. I invest for diversity. And so, like, I don't care really too much about cash flow. Okay. I care about long-term appreciation.
Yeah.
You know? And
the investment style, your long-term investing.
Yeah. And so it just really depends on, be careful as you listen to us, but anyone else, like, be so stern on calculations, like the 1% rule or the, different thresholds of why you shouldn't buy a property. It really just depends on your personal goals.
Of course.
So are you in it for long-term appreciation or cash flow? It's funny. I ask this question weekly. 90% of the time, the answer is both. You got to pick one. We got to pick one because there's two different tactics, two entirely different strategies to invest. You have to pick a lane and stick to it.
Yeah. No, I get you. And then, like, it's also that idea you say you can't pick both. When you hear that, that's the sign that maybe this person isn't ready, right? And they're even saying, like, that's just a can of worms I don't want to deal with. I'd rather just get both. Let's call it a change the subject kind of mentality. If you're in that avenue where you're like, I just don't want to deal or think about that, you probably shouldn't be in this field in general, right? Yeah. And I like your mentality of saying, like, we could give advice. The lender could give advice. I could give advice as a real estate agent. But in the long run, if you don't know your own stuff and it's more than advice than we're giving, we're actually counseling you on what you should do, absolutely, I would recommend don't get into this industry, right? Or at least plan to get in the industry of by the time you buy a house, you've utilized me to the fullest to where we're now equals when it comes to your decision-making process. But there is another thought that I wanted to bring up. You said that you're trying to, or it said every unit you have, you want to at least have $100 cash flow. I'd like you to elaborate on how you would calculate, because somebody might hear that and think, okay, well, my mortgage is $1,000 and my income is $1,100. Looks like I got $100 cash flow. Would you agree?
Yeah. Well, depends on that Excel calculation that you're working up. Are you using real numbers or not?
Yeah.
I think when we were, and now, mind you, I don't have the $100 rule. That's just a rule. I'll answer the question through that lens. But like when we were underwriting loans, and when underwriting means I'm just like when I'm doing my own cash flow calculation, when I was shopping the available market to buy my first house hack, I had no idea what I was doing. I've never owned a home. And so when you're running your numbers, you need to be very careful on the calculations that you're using, because a lot of them are just guesses.
Oh, yeah.
And so,
got feelings.
Yeah. So it's like, okay, market rent on Rent-A-Meter says it's $1,300. So I'm just going to throw that in there. Then this mortgage calculator on Zillow tells me my mortgage is going to be $980. Like, we're using, there are 5 variables now being used in a calculation that it requires another 20 numbers, right?
Yeah.
And so when our margin's $100 on our Excel pro forma, we got to be careful with that. And so the solution is to introduce a realtor, introduce a lender, and have them confirm the numbers.
Yeah. Have them just give their opinion.
Yes.
And if they're not liking, if they're seeing them iffy and they're not telling you, maybe ask them twice.
Yeah.
But
what are some of these, or what are some common variables that you see people, or especially first-time investors, just completely overlook, something they never thought of? Or even you, when you were going into it for the first time, I never thought I'd think about vacancy rate.
Exactly.
I never thought I'd, have the water, sewer, whatever, however
the
you
CapEx
plan,
expense,
however you plan on running your business as an investor.
Yeah. So like, let's just use the example I just did. So we just used rent-o-meter as the rent in the calculator. Well, you might be able to have a realtor give you access of those leases. And so you can get accurate numbers there via a realtor. You also, on the mortgage side, you can be connected with the lender and say, hey, 123 Main Street, I'm interested.
Yeah.
Can you help me run a real scenario for the total house payment? At which a total house payment, we have mortgage, taxes, insurance, and maybe PMI. Taxes, insurance, PMI are all estimates, and so.
So just to clarify, you're saying financing, because you said mortgage. Technically, the mortgage is all that, right? Yeah. In layman terms, right? So you got the loan, the principal and the interest, taxes, insurance, and then you said PMI. What were you saying?
Exactly. So.
Yeah. And PMI, just for our viewers,
yes,
what is PMI?
PMI, private mortgage insurance. This is default insurance. This is insurance that you pay, but the lender has. It's not insurance for you. It's insurance for the lender.
How do you avoid it?
Put 20% down on a conventional loan. If you are getting an FHA loan, the PMI does not expire. It does not drop off whenever you have 20%.
Yeah, so you'll have to refinance to a conventional loan. And the idea is, just to clarify, put 20% down. Basically what the lender's looking at is you owe less than 80% on the property's value in the market. So even if you put 5% down to get a grant or something like that, obviously harder to get when you're doing investment property. But something along those lines, you want to put 5% down because you want more money to put towards the property itself. You can work up to that 20% and then remove the PMI. It'll automatically get removed at 20%, or at 18%. You can scream and whine.
Yeah.
They might return.
Yeah, that's fine.
I do want to hit on another topic, though, from the original question, and then we can move on. Sorry. But when a person comes to you with an investment property and they're like, I'm done living in this place, or I've bought this place and I want to buy another one. What I was trying to hint on was, say they owe $1,000, or their mortgage is $1,000, and they make $1,000 on the property. That counts as debt, right? Would you agree? Because you can only qualify a certain amount of that property's income. You can't qualify the 100% of the income, correct?
Are you talking about the property they currently own?
Yeah, so if they currently own a property,
and they've been renting out the other unit.
Yeah. So the way I try to look at it is like when I have a client and they're looking at buying a property, I'm like, another thing you want to do is make sure you have 130% income versus your mortgage, due to the fact that if you go to buy another property, your lender isn't going to say, oh, you're making $1,000 on that property. Looks like the income on that property is $1,000. Traditionally, they're going to only count 75 to 80% of that, correct?
Yes.
Which would mean that extra $200 you're paying towards the mortgage is. So could you give me your point or perspective on that?
Yeah. So the scenario is that you, if I'm understanding you correctly, regardless, this is helpful. You've been house hacking a home for 12 months. You're ready to go and get your next one. The bank is going to want to see on your tax returns what the rental income has been. If you are showing a net operating loss, we have to count that loss against your DTI. And so it's a double-edged sword. You want to show enough income on your taxes to make the banks happy, to inflate your income and avoid DTI trouble, but you don't want to inflate your income so much that you pay too much in taxes.
Okay.
And so, but to directly answer your question, we care about the tax returns, not what your Venmo shows.
Absolutely.
And if you own a house right now and you haven't been renting, but you plan on renting your house, you're going to keep it, you're going to buy another one, but you keep your current. There's something called, I don't know, I'm drawing a blank, but you can get a lease and have it fully executed, and we can use 80% of that lease against your mortgage and omit some of the debt that way.
So it is cool.
So before they even move in.
Yes.
Interesting.
Yeah. So it is it's a cool concept to think about because people don't really think like I have a lot of clients that have huge ambitions. They're like, I'm gonna buy a house.
I'm gonna get 50 this year.
I'm gonna get 50 this year, and it sounds great. Deeper pockets is like, heck yeah, you can.
Yeah.
Sorry, deeper pockets.
Yeah.
But in the regard to it, I have these ambitious buyers, and I love the heck out of the ambition. But there's a very dangerous idea where they're gonna buy this property, not realize that only 80% of its income you're looking at confidently. And on top of that, if they wrote off like a lot of loss, so like I repaired this, I had to do this, here's the vacancy rate. And even though they collected a certain amount of money from that property and then they exacted all this cost, let's say if they were making $1,000 on that property and at the end of the year they made $12,000, you might only see $6,000 of that of income based off the fact that you can only count 80%. They had to repair this, they had to change out the utilities, and they went to their accountant and said, hey, I paid for all that. And the accountant's like, oh, that's, you don't got to pay taxes on that money then. They put it in, you're saying, oh, hunky-dory. Yeah. But then all of a sudden, when you go to get a new loan, your lender's like,
bruh. Yeah, and it's always after they file. I'm like, dude.
Yeah, exactly.
Which is really important, and stresses the importance of using a CPA that's real estate friendly.
Oriented.
Yes, like they understand what you're trying to do. They understand the house hacking method because they're going to look at it through that lens.
And it's not to say that accountants are bad. The accountant's core objective is to make it so you don't have to pay taxes on money technically you've already paid taxes on. Right. So that being said, what you're saying is not that accountants are bad, but a real estate oriented accountant is going to be like, hey, I'd love to make it so you can write this off.
Yeah.
But if you write this off and you're looking at buying another property, this is might be what it looks like. Right.
Yeah. Options are good, right? Especially the first time, depending on your age. I didn't know this stuff when I was starting out. And so... And I've been through a couple CPAs. Like you gotta just keep failing forward. But if you're learning something in 5 minutes, that it's important to have a CPA that's real estate friendly.
You can walk away with one thing.
Yeah. It's just how do you reduce the learning curve, right? Like we've all made the mistakes. Here's the solutions to them. Just do those.
Yeah, it is painful to think about that, and that's something you've been personally interested. We don't even have any ideas to talk about that here, but you have been really about the idea of what we've been talking about in the past. Politicians are all talking about you can't buy a house. We could go down this rabbit hole. We won't today, but can't buy a house. Today's younger generation just can't afford to buy a house. I know that irks you. I know you're sitting there I disagree 100%. Not with the fact that I'm not saying everybody could buy a house, but it's definitely a difference between education versus, capability. Would you agree?
Yeah.
Yeah. And I think that's the same idea with investing. You shouldn't attend a weekend class and then go out there pumped and be take my money.
Yeah. Well, there's a fine line with everything because there's analysis paralysis. And I know a couple people that we've been working on scenarios for 3 years and they haven't pulled the trigger, that's not great. But there's also the other spectrum is, people come up with this idea in 3 days.
Yeah.
And so it's just trust your instincts, get connected and get plugged in with people that are doing this. Everyone wants to talk about their successes. Just find someone that wants to talk about themselves and just obviously they have to be trustworthy, of course. But just listen to what they did. They will go to coffee with you. Ask them a billion questions. And
people love to talk about what they know.
Yeah.
Yeah. And I do like the idea that you brought up analysis paralysis as well. To condone on that, I've had a lot of clients that are just they're looking for that perfect property. And
how much would you equate this to our generation's, the younger generation's standards for the place that they want, the area that they want? How big of a factor do you think that comes into play with them? Again, analysis paralysis or failing to pull the trigger, right? It's not that they can't afford it. It's just they can't afford it in the area they want and the size that they want and all these other things. Is that something that you think of or even...
Yeah, I find that the people that don't have that problem are those that see the bigger picture. the people that are disciplined enough to understand that this is not my forever home. Mm-hmm. It's hard to do that because you know it's not your forever home, but then you see yourself living in there. You're like, well, I want a nice kitchen. I want a big bedroom.
Yeah.
I don't want a carport. I want a garage.
Well, my first house, I didn't even know what I wanted until I lived in it for 3 years. You know what I mean?
Exactly.
But even to the point just to keep it on the investing side of things, I think it's important to understand. I'm sure you guys would agree with me when I say you are going to buy possibly one of your least favorite investment properties. If you buy 20 over the next 20 years, your first investment property is going to become one of your I don't really care about that. And the only value it'll hold is it was your first, right? Yeah. But that being said, you're never going to buy that perfect property, especially your first time. You need to, analysis paralysis, you need to jump in. You need to take the risk. You need to be like, okay, this is a B+ property, and I'm happy with that, right? I'm not good enough to buy my A+ property yet. This is my first thing. For sure. And I would even argue if you could find a C+ property in your standards, you're still doing good versus trying to wait for that A+. Hunting, and then you're just missing out on all these properties. Because I would argue, instead of waiting 2 years, instead of waiting for the next season, you buy that B+ property. Now you're learning. Now you build an equity. Now you're getting the gears turning, and motion is a lot better in the investment industry than just stagnation.
Yeah, I mean, similar to stocks. Yeah. Right. If you say stock A is going to return 4%. Mm-hmm. And then stock B is going to return 12%, but you're not going to buy stock B until 2029. Well, but you can buy stock A right now. Yeah. And there's upside and there's likelihood that it's going to get to 30% by 2029. What would you do? Yeah. You would buy the first stock. It's exact.
But still, it's 4% return. Yeah. You're making money. Get things flowing. Yeah. I agree with you.
The way to lose money is to not take action. Yeah. Right?
And then we could go back and forth, but don't take action too quick.
For sure.
What?
Yeah, for sure. I agree.
So we're at 42 minutes right now.
So I'd like to at least, right, as we begin to wrap it up, right? We talked about minimizing the amount of borrowers, right? And the idea really is to maximize the benefits that you as a party or whoever can utilize. Why don't we talk about, I guess, some programs that exist here in St. Louis that could assist first-time home buyers, whether it's living on the property, living off the property. Yeah. Why don't you talk about that?
So let's get the first side out of the way. Investment properties, you're not getting any grants, nothing. So if you're not if you're not gonna live in the property, that means it's an investment-specific loan, and there's no free lunch at all. If you're going to live in the property, aka house hack, this is why the house hacking method is so attractive, is because it doesn't matter if it's a 1 unit, 2 unit, 3 unit, 4 unit, the bank still looks at you like a first time home buyer buying a white picket fence, And so with that, you have all of the available first time home buyer products. My favorite is MHDC. Missouri Housing Development Commission, I think is what it is. And there's a variety of products. One gets you a very sub-market interest rate if your income is below 80% of the area median income. So that's lovely.
Area median income is a very key factor, right?
Correct.
That can
of all change. Of these first-time home buyer products.
That can change tremendously. Yeah.
Yes. Another MHDC product, they give you 4% as a down payment assistance. So 4% of the purchase price is used as a second loan to cover your down payment and closing costs. Great product. Now with these though, they kind of tie you to the property. Yeah. And so you have to be a little cautious on using grants and using first-time homebuyer loans because at the end of the day, there's no such thing as a free lunch. Yeah. And so the way that I coach new investors is to plan. Like you need to bring in your own down payment and you're going to need to bring in your own closing costs. And then you plan accordingly. You have enough money. Because the thing that we want to avoid is it's closing day and you got the $5,000 from MHDC, you had seller credit and your cash to close was $1,000 and you have $0 in your bank account.
Yeah.
That's a terrible start. Like when I had to pay $3,000 for like a foundation situation like a week after we house hacked and closed.
Lovely.
So yeah, just utilize and understand the products. Again, everyone's situation is so different. Have a lender explain them to you, and then kind of audit your own situations.
Yeah, and one other point to that, a lot of grants require that you own the property for some time to slowly pay those back. I see some buyers when they go to resell, like within 3 years or even sometimes 5 years, you still might owe some funds towards that grant. It's not free money.
Yeah.
You know, it's not free money. They're expecting something in return. Either, you live in that property, contributing property taxes or some kind of return in that retrospect.
Yeah.
Can be free money. You just got to know.
Yeah,
how
and not to say they're bad, right? You just have to
No.
understand the risk and make sure you're making the decision.
Absolutely. And there's very minimal risk. You
Yeah.
know, as long as you know what you're dealing with, technically you could say there's no risk because you know what you're dealing with. But yeah, I get you. Cool. What other ideas do you got?
I think we wrap it up.
Simply said. Matthew, thank you so much. You ever go by Matthew or no?
When I'm in trouble, yeah.
Okay, Matt.
When I don't cut the grass on time, or
You're doing
don't
great.
take out the dishes.
You're not in trouble today, Matthew. But yeah, thank you so much for joining us. We'll be sure to show you some love on all social medias. Yeah, guys, you just heard Matt Dickens with Dickens Mortgage. He is your lender, particularly dominating the first-time homebuyer industry, as well as a personal interest he has in investing in house hacking and all that jazz. He's done it himself. So if you guys are looking around and you guys need a lender that you guys can trust, definitely Matt Dickens is the one.
MattDickens.com. Just find me there.
Oh, shoot. That was bad. Out of the bone right there. Cold-blooded. Thank you. Well, guys, thank you so much. We'll see you later.
See ya.
Good night. Or good day. All right.
Are you done? I have to pee.